Welcome to your CPA's Take on Real Estate. We're your hosts, Daniel Ricotti and Kyle Paxton, back for another video. And today's topic, we're going to talking about how to actually raise funds and make investors say yes. The first half of 2026 has been pretty interesting.
Yeah.
The amount of private real estate fundraising is actually down. It's at an all-time low, I'd say about since 2017, and it's about 38% lower this time than it was last year. So real estate altogether is in a little bit of a slump, and the investors are noticing and putting less of their money into their deal. So if you have a deal now, it's going to be a little bit more difficult based on the current environment to get investors, but that doesn't mean they're saying no. You just need to know, how do we get them to say yes? And in today's environment, what are investors looking for?
Oh, yes, Daniel. This is one of my favorite topics. I love talking about this. I love the investor relationships component of real estate and, bringing them into deals and making sure they stay happy through the life of the deal. And so, we kind of go through these cycles where, to your point, like in 2025, good bit of real estate investment in these types of deals. The last several years kind of been this way. We get law changes that drum up that bonus depreciation buzzword that drives capital to real estate for tax savings perspectives. I think real estate's a tool where we talk about a lot is a good, just a good investment period across the economy. One of my favorite topics to talk through with our real estate operators and syndicators is this investor relationship piece. I think it's huge. So let's take us a little bit into like, all right, so to get me in the door, I need to see like a high projected return, right? Like that's step number one, but that's kind of low hanging fruit, right? Let's get into a little bit on what makes our investors happy.
Yeah, I think there's a lot of miscommunication or
Yeah.
misconception here in the space. Like, yes, investors want high returns, but you're just a high return maybe just gets an investor through the door, maybe it
Yeah.
starts getting you talking. It's definitely not going to close the deal. Okay. And actually, sometime even, if it's unbelievable, it might not even do that. So I really challenge the idea that, all right, I'm getting a high rate of return or a high ROI. Okay, maybe that gets me a conversation in the door. But the really investors have moved beyond that point, and that's really not going to be it. So you really got to really look into like, all right, what are investors making their decisions around? It's more than just the deal and what their return is. It's going to be more about the sponsors, like you and your team and your relationship. So LPs are looking for in 2026, they're looking for more durable returns than these presentation driven returns. All right. Uh,
Doesn't need to
I
be
see
shiny necessarily, that deck, right? It's just gotta be foolproof.
You're right. Investors today, they're more realistic. All right. Like they're not being like, okay, the 30% return over a year. Yeah, that sounds nice in theory, but it's probably unbelievable. Like show me the numbers at that point. Okay. So they're really looking at like, where's the cash flow going to be at? Is the rent growth really supported by markets and the evidence in the market? Where's your operational improvements now? Okay, you think I'm going to get this much return? There has to be a reason why.
Yeah.
There needs to be some kind of improvement, because if there's no improvement, there's no way I'm getting that based on the market. Like, where's my advantage at? Okay, and then with debt and everything that's going on, where's my debt pay down? What does this look like to me? And what is a realistic exit? I've seen more unrealistic exits, and that could, while it might be great on the sales side, investors are finally catching on. Like, hey, you sold me that I'm going to sell it at X in 7 years, and here's 7 years, and we're not getting that anymore. And that could really hurt investors, especially reoccurring investors here.
Yeah, and a lot of this comes down to I'm finding that like the investors either want to be more educated in the real estate investment they're getting into, talking about the LP perspective. There feels like there's less just kind of quote unquote blindly throwing money around, right? And in the age of AI, Chat GPT, you can get kind of a quick elementary education on what you're doing quick. I've seen more interest in really understanding the inner workings of the deal. So like you talked about, actually, what is driving the return? When should I expect the return? And then the when should I expect the return in the form of distributions or, like payments through the life cycle of the deal better align with what actually happens, because that's where the kind of trust component comes into play, or there's clear communication around that. So, we talked about briefly, we're in kind of still a tighter real estate market. The biggest thing is downside protection. Daniel, you and I have talked about this several times in this video series on the last handful of years, maybe quote unquote anybody could get into a multifamily property and make a return. As the market's gotten tighter and gotten a little squeezed here, we've seen some separation in the operators who are doing this correctly and the operators that are having a hard time. So like investors are diving deeper into your leverage and debt service coverage. The interest rate exposure is a huge one. We just talked about this with refinancing and having to get creative on potentially additional capital raises. The capital expenditures and operating reserves are always huge in real estate. And then, in some asset classes more than others, really scrutinizing that break-even occupancy and understanding the rental income. And now we're not just projecting what our rental income could be, but a realistic, what are we going to fill, has been big. And then, making sure we're thinking through the effects of the slower leasing, rents, delayed sale, those types of things. I want to jump into this control comes up a lot. And investors, tend to, this kind of gets back to like the trust of the operators. And I'm seeing where and gets back to that education piece, like LPs, maybe they want direct ownership, but there's a broader preference here of visibility, influence, like strategy specific exposure to be a part of the team and not just blindly sending money. Right. So we're seeing that a much more prominent theme. And then this just takes us into more of the communication and, clear expectations.
I mean, what I'm seeing here today is historically investors in real estate are aggressive people.
Yeah.
They're in there for a reason. They're not just trying to buy stock and get the stock market. They're wanting something where they can get higher returns,
Yeah.
greater control. There's a lot of great things with real estate, and that's usually it leans towards more aggressive people. But today's market is making everyone being a little bit more risk adverse. Even the most aggressive people have pulled back a little bit. So they're just really wanting to understand, like, all right, I don't want to lose my money. That's the worst thing you can do with an investor. All right. Even if you got to sacrifice a little bit of return, they will do that as long as they don't lose their
Throw
entire amount.
everything else. None of the rest of this stuff matters if you lose the investor's money.
Correct. They're never coming back at that point. You lost them, and you might even get yourself, unfortunately, in some court cases and have to deal with getting sued. And so you don't really want to do that. So investors right now are really, like she said, protecting that downside. So you need to make sure you're doing the same when you're conveying, all right, here's my new deal here. You really need to be looking at, all right, worst case scenarios. Do I have a plan for everything? Not making just crazy assumptions, especially of the refinancing, that the best market's going to happen, the best refinance rate is going to happen when I need it. That's just not the case, and investors have gotten probably burned or dealt with this, and so especially the better ones here, they're wanting basically more visibility, and they want you to demonstrate that you know what you're doing and you're capable to basically pivot if the market gets worse or anything like that. And so now more than anything, it's just transparency has now part of these investments. Okay. Before, maybe you could get away with, hey, here's your money back, here's a great return. And they're just like, cool, don't know anything, and I'm just 100% passive nowadays. That's not what we're seeing. We're seeing more transparency. And so when you're dealing with investor relationships, you need to really understand that you need to be transparent up front, and then you need to continue that transparency throughout the investment all the way to close.
Yeah, Daniel, I'm going to talk a little bit just more on the upfront piece, right? Because right now with deal modeling, I feel like everyone I talk to is implementing AI in their deal modeling process. And so, it's allowing operators to get much more information on a deal quickly, concisely. You can use it in so many different ways, but I think the important piece is to really be able to turn that into the education to the LPs on here's how AI was implemented into this system, but then here is how I have kind of foolproof checked that. I've downside protected against these assumptions that are kicked out to me with all the million softwares and everything else we have available there. So I think this is more prevalent than ever too, just with the increase in the inputs that are coming in. I think it's really helpful to make sure that we're laying that out clearly on the front end of the deal. And like as the deal goes on, we talk about this a lot, where it's just are you communicating consistently with your investors? If there are variances to the model, get out in front of that. It's like that's I deal with it quite frequently, where investors are blindsided by that K1 they get, or they realize, they didn't get the distributions they were expecting in a given year. And typically cash is what causes pain points in this process. So getting out in front of cash flow issues, it goes a long way here. Daniel, do you have anything else you want to add on just those, like that transparency component, before we dive into a little bit more of kind of track record versus deal quality type stuff?
Yeah, I just think with the transparency that it just helps that relationship a lot. Even the most reasonable investors, they understand that it's never going to go 100% to plan. So do you have a plan in place? Are you giving me worst case scenarios? And do you have a plan when that happens? If you're using assumptions, we all have to use assumptions. Where do they come from? Do they come from credible sources? Or did you just throw a random number on a page? Like, we don't know that. Are you modeling these things right here? All right. And then, like Kyle was saying, money, cash is king. So anytime you're dealing with money, like, distributions do not meet expectations, there needs to be transparency. There needs to be a reason why, and there needs to be a plan to get them back on track. Okay. So anytime conflict arises, something like that, we really want to see it. And then if there is some downside, okay, why is this happening? Okay. Were we expecting it? What's our plan going forward? That's really what it is with investors. Is when something change, I'm getting out in front, I'm letting them know, and there's a plan in place to correct it. So when you're dealing with this, it's just transparency is at an all-time high now. But it's not, transparency is great, but what we're really wanting to see with a lot of our, with a lot of our sponsors is, all right, how do I get that relationship? How do I get that credibility? And that comes back to your track record. Okay. And so a deal can be great, but if you don't have a great track record, investors might still not want to deal with you. So, but how do you get a track record, right? It's the chicken before the egg kind of thing, right? You gotta,
You gotta start somewhere.
you got to start somewhere, right? But they all play their different roles here. But that's what we want to have with all our investors, is we want to get to that point where I have a great track record. Because if you give an investor, you have a great deal, they get exactly what they were expecting, they are significantly more likely to invest in you next time, because they know from their track record, or they tell their friends about you and everything. So it's really important that we start, especially for new sponsors. All right, I got to do everything right at first so I can gain traction, get that great track record, and then everything is going to be easy. But that doesn't mean I turn off the deal, or the deal doesn't matter anymore. It's not a good deal. You still have to have good deals, but that track record just gives everyone else that sense of security that, all right, I believe in this person. I know he's going to take care of my money, and he's going to do the absolute best they can to give me everything back and the highest rate of return.
Daniel, two comments I want to make on this, on the track record piece. Repeat investors says a lot, right? Getting an understanding on a deal you're thinking about entering, how many those investors are in this new deal that have invested with the group before. Big sign on track record and trust and everything else, right? Love that conversation. And then on the flip side, less of a track record, newer operator trying to generate funds in a capital raise. What I see work here that's so important is, like, everything has to be aligned from the get-go. So it's like having the right mentor in place who's older and more experienced. Real estate's a mentor business. Typically, it's relatively easy to find a mentor People like to talk about their successes, right? And failures. And pass that on. So like having the right support around you in that regard, and then surrounding yourselves either internally with a team. A lot of times that's not super realistic for our new operators, but having the right attorneys, CPAs, property managers, if that applies, like getting all of that aligned on the front end before you're going and doing the heavy lifting capital raise really helps sell. And picking people in those positions who have done this before helps increase your credibility and add that peace of mind we're talking about here. Um, and I think like track record's super important, but in 2026, when we're talking about this, it's all about the deal right now. And just really scrutinizing the deal itself and not lending all of the weight to track record is very important. But both go hand in hand. And if you have an outfit who has done a repeatable investment strategy and it works time and time again, hard to say no to that one.
Yeah, the track record, it will open the door, but it does not rescue a weak deal. Okay, let's keep that in mind. But if it's a complex deal or complicated deal, a strong sponsor with a great track record might at least get some ears, where a weak sponsor who doesn't have any track record will not. So there there is absolutely they need to go together. Get a strong track record with a great deal. That's where you're going to get the most success. And obviously, a strong track record just starts you by doing things right, creating transparency, understanding and gaining that trust of that investor there throughout the whole process. The more they do that, the more likely they're willing to come back and at least listen to the next deal. Even in a tougher environment right now, there's still people putting money in the deals. They're just they're being a lot more strict with their money, and just not letting it flow. So just trying to encourage people that, hey, once track records really help you out, but also in reverse, once track records get broken, it can get really hard to climb out of that hole that you're in. So make sure that you're always doing everything correct. And even if a deal does go bad, there needs to be transparency. There needs to be obviously effort with a plan of trying to get everything back from investors so that you don't tarnish your track record on one bad deal.
Daniel, we work with a ton of real estate operators and syndicators, right? The ones that I don't know what the right word I'm looking for is. We'll say appreciate the most are the ones who are almost loud with their mistakes, like historical mistakes, and own them and communicate them to investors, even as part of a new deal proposal. As hey, here's the because you pull up any website for a real estate syndicator and there's 100 million successes. Here's the return on this, whatever. But like, I really appreciate when all those successes are still advertised, but then you bake in the lessons learned from the things that didn't go well and why this is different than the things that didn't go well. Like, I think that's huge in just establishing the trust of the year. Like, nobody's perfect. I'm not perfect as an accountant. But like, if you own those mistakes and can, use them to get better and then add that as part of your transparency, I think that's so big for credibility and kind of getting in that repeat investor mindset, even if a specific deal doesn't go well. So let's dive a little bit more into like red flags. I think not having a credible downside case is a red flag. I think, if you're an established real estate operator and you don't have mistakes that you've made to share, I'm skeptical, right? Like, there's a lot of deals, and things don't always go to plan. So I'm immediately kind of questioning things, right? So, I think red flags we dig into is like, okay, are these returns that we've modeled, are they dependent on market rescue, right? Either there's like aggressive cap rate compression, we're projecting above market rent growth, some sort of refinancing terms at materially better terms. We talked about how that side of things is tight right now. And then just sale timing, just being maybe too aggressive with that, that can trigger some light bulbs and red flags with investors. And then, I think
I
sometimes,
always I
yeah, go
always
ahead.
say that I always say, Kyle, I just want to
Yeah.
come in here for But it's like, if the deal sounds too good to be true,
Yeah, it probably is.
like, even if it probably is, you really need to tell me on how this is. And right now, I see too many times where it's this optimized scenario
Yeah.
where the market gets better and saves my deal. And I'm like, that's not, I don't know if that's going to happen. Like, maybe, but I wouldn't count on it. I wouldn't put my money on it. So when I'm looking, I'm like, show me realistic here. Like, what is a realistic rent growth schedule look like? If I see it's too high, too aggressive, all right, what am I doing on refinancing? Refinancing right now is a huge issue with a lot of real estate. And so if you're just expecting to get a great, really refi at the when needed, that's a huge issue here, Kyle. And so I just really think we need to make sure that we are giving accurate numbers, maybe even leaning on the side of conservative. And we're not trying to sell best case scenario. We're really trying to sell is a solid deal with a good plan who is willing to be flexible whenever the market gives them, but it's still going to be successful even if it downturn.
All good points. Another thing that I think like that to me is somewhat lower hanging fruit in the investor red flag, arena, right? Like the your returns are too high based on one of these inflated factors. I think one of the areas that maybe doesn't get enough scrutiny from investors, but is so important in all of these conversations we've just said is like the capital structure. And what is the funding plan? What kind of options are on the table if the funding plan doesn't pan out? If an extension or refi is needed, what does that plan look like? Do you have floating rate exposure without adequate protection? And then like, what is the getting a clear understanding? I think this question's asked, but maybe not the rest. But like, when can I expect distributions and actually getting some return on my cash? And does that align with a realistic expectation on is the asset operating and stable to where there is actually free cash to distribute? So, I think that piece is something that investors tend to fixate on a lot, just the cash. And when do I get the money hitting my bank account? But I think the broader conversation that's super important right now is digging deeper into the holistic capital structure. And I'm not sure that investors really do that to the extent they should when they're betting deals. Um, so that's an area that can potentially spur red flags for investors, but an area that I don't think our LPs dig enough into, right? Um, and then some of this is a little bit of just uh, I think somewhat obvious, but like communicating inconsistent information, right? Does your slide deck actually and your modeling actually align with the expectations? And then are the communications around differences well executed? And then kind of with that, because sometimes this leads into the inconsistent information, like as an organization, do you have the proper infrastructure to actually manage the deal in question, right? How many active projects does the organization have? Are you, like, do you have a concise strategy firm wide, or are we kind of shotgunning different types of investments? What's the dependence on one key individual? Does that individual have the right team internally or the right advisors around to properly support and transition if something were to happen? And then, whether or not it's internal or the outsourced piece, like, are there those dedicated accounting, asset manager, investor relations capacity available? And this gets back to my point before on like, for our newer sponsors, do you have the right professionals around you that you can show and demonstrate the proper infrastructure to scale?
Yeah, and Kyle, some other things that I look at here, that are just kind of red flags is like, let's say that everything I hear from you is just amazing. Like, I don't hear anything. Like, there's no like, hey, this one investment, I didn't do quite as well, but they were on top of it and
Yeah.
everything. So it's like when you go look at Google reviews and you see
Yeah,
all you see is 5-star reviews for something.
if
You
there's
know, like that,
25-star reviews, are those
yeah,
legit? You know?
a little too good to be true, right? Like there's no successful person that hasn't had challenges, all right? And a lot of lessons learned is basically, all right, when that challenge happens, how do I do it? So you can also swing the other way and also be skeptical because there's
Yeah.
too many. But no reviews is bad. Too many 5-star reviews and no 4-star reviews. It could be bad as well. So just keep that in mind too. Here is there really needs to be an understanding of, all right, there's probably some challenges that came up, but how did you respond? And that actually can provide more credibility for you, because that's realistic. That's how life is. Nothing is perfect from you. Okay. Um, and then also, we just want to make sure that whatever you're doing right now, the organization is able to handle it. If I see a sponsor with 1,000 deals out there, I'm going to question that you're going to have enough time to actually care about my deal that I'm in right now. Okay. Um, Too many different strategies. Are you all in on multifamily, or are you doing something across every single industry? It's hard to have a niche. It's hard to know exactly what to do in multifamily when you're doing industrial and
Yeah.
retail and data centers and everything right there. And then I'm looking at your company. Am I seeing high employee turnover? Am I seeing reliance and dependence on just one or two key individuals? So your organization, your team matters as well here. Investors may question this because the fastest way to lose investor comfortability uh, is that your organization looks like it's going to fail this deal because it's just spreading itself too thin, or there's looks like there's something going on internally there.
All right, Daniel, let's tie this thing up with just that establishing credibility piece for our newer sponsors. What does it look like? And I really like to think through this in kind of a three-layer system, right? You got, it's like a funnel. We like funnels. But you have proof of the deal, right? The specific deal. Can I show the work that demonstrates my key assumptions? Explaining basis and how we get there, presenting debt and reserve strategy, talk through the two or three different variables that identify most, like what does a downside look like and what happens there? And then what are the scenarios in which the sponsor would exit this deal somehow? And what does that look like? Like being able to lay all that out, layer one. Layer two, proof of the team. Really understanding, I'm not going to spend too much time on this one because I feel like we beat it to death, but like, how did we get this deal? Who sourced this? How are we going to service it? What are the professionals involved that are managing the accounting and investor reporting? If we're not doing that internally, who steps in if a key person's unavailable? Like, what is that infrastructure? And then taking that again a step further to layer three, talking about kind of the proof of the institution, right? What is the overall company um, uh, policies? Like, what does the reporting calendar look like? How is this company administered, and how does that relate to me as the investor? So, to fully like kind of close the loop on credibility, um, there's I think three behaviors that really that lend itself to establishing that credibility that we see. It's disclosing the weaknesses before they're asked, getting out in front of that. Um, and offering solutions if possible before the solutions are asked for. Are we answering like diligence questions directly rather than defensively? I think it's easy when your model is breaking down to have a more defensive posture. That's not helpful for anybody, right? So trying to level set and be clear, it's just like managing my 3 and 4 year old. Like if I'm having a direct solution and how to move forward. And then I think with that kind of the proof of the institution layer three conversation, like um, going into a specific deal, are you promising a level of reporting or access that the organization can't maintain as part of the broader institution? I think those are three behaviors or things to keep in mind that lend a long way to establishing credibility in these types of deals.
Absolutely, Kyle. So let's wrap it up here. And so I will say, like, usually when I'm thinking about investors, I'm thinking of like 5 questions in my head. If I'm
Oh,
selling to
good
investors
one. I like
here,
it.
like the 5 question test,
Yeah.
kind of something like.
Okay.
So basically, first is, if I'm an investor, do I understand why this deal should work? Okay. As an investor, I need to understand. So you need to be creating value creation plans that are specific and economically supported. Okay.
Hopefully we can get
Two,
that far. That feels like we can do that one. Okay.
right. So, second one is, do I understand how it could fail? All right. There needs to be a failed situation. They need to understand that there's always risk involved. So the investor should be able to identify the primary risks and how we're trying to protect those from those risks. Okay. Do I trust the assumption and the supporting information? That's 3 here. All right. The investor needs to untrust these assumptions. You understand, all right, this is an assumption, and this is the data we're using to come up with it. The numbers should be consistent, sourced, and clearly defined. All right. 4 is, does this team have relevant ability and capacity to execute? Okay. Not only does sponsor needs to be credible and have experience, but the team, can you deliver? The investor wants to know, is this current organization right now able to deliver on this deal and this plan that they put in front of me? And then last question is here is, do I know how I will be treated after the capital is committed? This goes back to transparency. We need reporting, I need communication, we need governance, I need candor about the part of the investment deal here. So if I'm an investor, these are the 5 questions that I want to make sure that I know the answer to before I'm willing to put money into this deal. If you can't answer those questions to these investors, make them feel comfortable with your deal, in today's environment, you could still get investors. It's just going to be a little bit more difficult. You just can't throw big numbers in front of them and hoping that they'll just be willing to commit their money off just some high numbers alone.
Great conversation today. Take us out of here.
Well, it was. Thanks for stopping by, and we'll see you next time.